Hi everyone, welcome to today's webinar. This is the first of our two Academy Accounts workshops. I'm Catherine Patel, I'm a partner with Buzzacott's charity and not-for-profit team, and presenting today with me is my colleague Matt. So just starting off with a little bit of housekeeping, automatically your videos and microphones are off. We should have a little bit of time for questions at the end. You can ask questions through the presentation using the Q&A function in Teams. If you use the speech bubble, it's the speech bubble on the right hand side of your screen. Questions will be kept anonymous. If we don't have time to answer questions at the end, then we will follow up afterwards with our responses to those questions, and after the webinar we'll also circulate slides to everyone as well. So we aim to cover this session in around an hour, so finishing by approximately 3:30 this afternoon. So just in terms of the items to be covered today, and this is really a webinar for those who are newer to the sector or want a refresher on some of the accounting and reporting requirements, but also stepping into some of the audit requirements as well. So from an accounting and reporting perspective, pretty stable this year overall, not many changes coming through in terms of the ESFA's guidance. On the auditing side, which Matt will cover, some changes that are coming through in revised auditing standards. So we're just going to start to look at those, and particularly the impact on your year-end audit process as a result of those. So I'll start really with an introduction to the reporting framework, covering some of the accounting points, and particularly those points coming through from the ESFA's accounts direction. So if we just go into the next slide. So really just to start off with the very much the background, and I'll go through this pretty quickly as you're probably all pretty familiar with this, but ultimately, why do Academy Trusts report as they do? Your UK companies, so companies limited by guarantee, and you're also exempt charities. So being an exempt charity really means that you need to follow charity reporting frameworks. So your accounts and annual report must follow and comply with a certain degree of regulation, reporting framework. So quite numerous in terms of Companies Act reporting, UK accounting standards, so FRS 102 is the prevailing UK accounting standard that you follow, and as I said, also the charity reporting framework, which comes through as the charity statement of recommended practice, which is based on FRS 102. The ESFA, through the accounts direction, also has additional reporting requirements, and actually what the ESFA do in their annual accounts direction is to bring together all of those requirements, both for single academy trusts and also multi-academy trusts. And the model set of the accounts, the Coketown Academy Trust model accounts that they issue, they make sure that those model accounts comply with all of those regulations. In the guidance, occasionally reference to company reporting, charity SORP reporting as well, where the level of detail in the accounts direction isn't quite so detailed, and you need to refer to other guidance there. So just moving down to the next slide. In terms of the accounts direction for 22 to 23, recently issued in April 23, obviously for this year's accounting year end, so 31st of August 23. As I said, incorporating all of those requirements in terms of the reporting around FRS 102, the charity SORP, and then further the ESFA additional requirements. And it really tends to be those ESFA additional requirements that really bring the areas of greater complexity to the accounts, and certain disclosures, additional disclosures that you need to provide for your Academy Trust within your annual accounts. And the aim of today is really to cover some of those and really to provide a refresher, but also to let you know what's changed this year, both in the narrative reports that go with your accounts and also in the presentation of the financial results and financial position. As I said, we're including reference to the model Coketown Academy Trust accounts, and we replicate some of the pages from that in the slides and in the guidance we're providing. Only minor updates this year in the slides. Anything that's come through new this year, we've highlighted specifically, and I'll draw your attention to those points as we come through. There is also mention within the accounts direction there's also mention of the ESFA good practice guides. That was something they've sort of come in over the past couple of years. Also useful to refer to in particular areas. A couple of examples of those where they impact on your reporting are for the streamlined energy and carbon reporting, if you're required to disclose that within your trustees report, and also ongoing concern as well. So the requirements for the trustees and the reporting of going concern within your annual report and accounts. So again, worth a read through there in conjunction with the accounts direction. So first of all, I'm going to look at the narrative sections of the accounts, and really starting with the sort of the annual report and the key elements of those narrative reports. So if we just skip through onto the next slide. So really, what are the narrative reports included within an Academy Trust set of accounts? The first major item is the trustees report. So ultimately, that is the report that tells the readers, the public, really what the Academy Trust has achieved within the year, its financial performance, academic performance, and also looks at some of the organisational and governance structures as well. Should be heavily tailored to the trust. The governance statement, the second major narrative statement made by the trust, by the trustees. So the governance statement is more prescriptive in format, but again has to be updated for the Academy Trust specifics. This is looking at meeting attendance, subcommittees, internal control as well as part of that, and I'll come on to a little bit more detail shortly. The accounting officer makes a statement then on regularity, propriety and compliance, assuming all is okay in the year, and that follows a template set by the ESFA. And then we have the statement of trustees' responsibilities, and again, very prescriptive in form, and there's the wording there within the model accounts, the Coketown model accounts, so to be literally copied and pasted into your annual accounts. And then the other two reports are our report, so the audit report, so one on the financial statements and one on regularity. The regularity report template is included within the Coketown accounts. The financial statements report will be given to you by your auditors, so they will define some of the wording within that and follow their own templates. The ESFA feedback around the narrative reports is that some Academy Trusts have not tailored these sufficiently, that they've sort of copied too much of the Coketown Academy Trust accounts. So do make sure that you don't necessarily follow template text, particularly where it's expected that you're updating this for the circumstances of your own trust. So if we just go down to the next slide and look at the trustees report in a little bit more detail. So a lot of requirements here in terms of content. The accounts direction and the model accounts really drill into this in a lot of detail. There are certain items within here, I'll run through them, but certain items that are only required if you're a large company, as classified by company law. But a lot of links within the accounts direction and the model accounts to that guidance. So just running through the list here, reference and administrative details. So this is a list of your advisors, a list of the senior leadership, senior management team, and also the list of members and trustees who've served during the year, but also to make sure that the list reflects the members and trustees of the trust at the date of approval of the accounts. So probably November, December this year when the accounts are approved. Any post-year end changes to members and trustees should be reflected within this list. We then go to structure, governance and management. This is an area that probably year on year, although heavily tailored to the trust, is probably very similar year on year for your own individual trust. Arrangements for remuneration of key management personnel required here. You need to define who key management personnel are. So that will typically be the trustees, the board members, together with your senior leadership or senior management team members. You define this here, how you set pay, remuneration for that group, later on in the accounts, you'll be disclosing the aggregate amount of pay that has been paid to that group. A few years ago, trade union facility time requirements came in. That's if a trust has over 49 employees, so pretty much every trust being caught by that. And then we have engagement with employees under this section. That's if you have over 250 employees that you're required to give a statement on how the trust engages with its own employees. And then the next requirement in terms of engagement with suppliers, customers, others in a business relationship with the trust is where you meet the criteria for being a large company under the company law definition. So that's the thresholds for revenue, gross assets and employees. So you meet that if you meet those the threshold, for example, the 36 million annual income, if you breach two of the three thresholds for 2 years in a row, you're defined as a large company and have to disclose this information. As I said, more information and links are included within the model accounts. And then organisational structure, particularly around any subsidiaries, joint ventures, associates, the function of any trading subsidiaries, decision making, subcommittees here may be referred to. There'll be further detail on subcommittees within the governance statement. You then have your objectives and activities, so charitable purposes, your public benefit statement goes in here, but a relatively short section. What were the activities you set out to do in that particular financial year? And then you move on to the section really that's tailored really quite heavily year on year, and that's the strategic report. So the first section there being achievements and performance. So this is looking at academic performance, maybe KPIs, starting to expand into financial performance as well, with a separate section on financial review. Within here, we'd also expect to see a going concern assessment statement. This will also appear in your accounting policies, which we'll come on to, but this is the trustee's assessment of the solvency of the trust and looking at the period as a minimum 12 months from the date of approval of the accounts. So basically if you're approving your accounts in December 23, does the trust remain solvent, able to meet its debts as they fall due through to December 2024? And you need to make a statement around that. Again, another large company requirement here, the statement on how trustees have promoted the success of the company. And then we have the financial review. So the financial review will include your reserves policy, a statement on principal risks and uncertainties, and also just a brief statement on fundraising practices. And that's a nil statement. If you're not undertaking any specific fundraising, then you will also say that within the report. The bit that's changed this year, highlighted here where we've got the including estates. So this is around risks and uncertainties. So one of the main changes this year is that the ESFA have set an expectation for trustees within the accounts to acknowledge their own responsibilities relating to the trust, the schools, estates. So estate management. So what the accounts direction is now saying is that the principal risks and uncertainties should cover the risks impacting on trustees' responsibilities to ensure the trust's estate is safe, well maintained and complies with relevant regulations. This has partly been driven by some of the, as you'll have seen in the press, and some of the DFE communications around some of the materials, the concrete, for example, that there are some buildings in poor condition at schools. The DFE wants to emphasise the need for trustees to remain vigilant to that and to report on this risk within their own accounts. Future plans, a statement there. Again, that can be relatively brief, maybe a few bullet points around what the trust is intending to do over the next year or so. And then again, for large companies, the streamlined energy and carbon reporting, as per previous years. This came in, I think it was 2 or 3 years ago now. There's specific guidance on that within one of the ESFA good practice guides as well. Just turning to the next slide, just a few points to emphasise here in terms of the financial review section. So the ESFA really making it clear that they want clarity in this section, so that a non-accountant would be able to understand the financial position of the trust, and particularly given the way in which the numbers are, the financial results, the numbers are represented, they can be quite complicated. So this is your chance to really give a very clear view and clear picture of the organisation's finances. To also include financial effect of any significant events that have happened in the year, the principal risks and uncertainties, as we mentioned, but also the mitigating actions that the trust is taking to try to minimise the risk in those areas. And as I mentioned, the estates management element must be considered as part of this for this year. Anything going forward in terms of finances might need to be mentioned here if there is anything sort of key factors going forward. And then really anything material, significant in the context of your financial results, financial position, again, should be mentioned as part of this section. What you will need to do, and we'll look in a second at your operational position and how that can be drawn from the accounts, but you must be reporting here around the underlying operational results for the financial year. So really typically the result that trustees would be overseeing in terms of your operational budgets and how that has panned out in the year in terms of actual results. Key sources of funding to be mentioned, and as we also mentioned, the fundraising side of things as well, and a little bit more information there, particularly if there is some significant fundraising that's been undertaken during the year. Moving to the governance statement now, as I said, this is a little bit more prescriptive. If we just turn to the next slide, yeah, brilliant. So the headings in the model accounts are mandatory, must be included within the trust's governance statement, but you will be tailoring the wording, obviously in accordance with your own trust's circumstances. So really this is setting out the first half or so of the report around the governance arrangements, governance reviews as well to be mentioned here. Board members, so listing of board members, meeting attendance statistics to be included within this report as well. Mention of the trust's adherence to the governance review arrangement, so the requirement to self-assess annually and then have periodic external reviews as well, governance reviews. So mention of that and what's been undertaken during the year. Explaining how conflicts of interest are managed, so that came in for the first time last year. And then also looking at subcommittees and at meeting attendance for the subcommittees as well, and that's not necessarily all subcommittees, it's those relating to finance and audit. So for a lot of trusts you'd have the finance committee and maybe an audit and risk committee, so looking at the attendance at meetings and composition of those committees. Review of value for money then forms the next main section of the governance statement. So this again here mentions estates, safety, management. So for trusts to consider demonstrating how they've effectively used funding in order to ensure that the trust's estate is safe, well maintained and complies with regulations. So again, expecting to see mention here of estates. The other main section of the governance statement is on internal control. So the review of the effectiveness of those internal financial controls in the year, and also your internal scrutiny arrangements. So the internal assurance, internal audit arrangements, making sure that you note the detail, some of the detail of the reviews that were undertaken during the year and the findings from those, particularly if there was anything material coming through. In the SFA's feedback, the bits they've often said are missing here or not covered as thoroughly: the governance review requirement. If your board meets less than 6 times per year, you're required to say how they've maintained that level of oversight as trustees. And then the other area is internal assurance activity. So just making sure you're really meeting the requirements on that as well in terms of disclosures within the statement. So just the final statement to cover. So this is the statement that the accounting officer signs on behalf of the trust. As I said, pretty prescriptive, assuming no issues have arisen in the year. So basically the accounting officer is confirming no material irregularity. If there are irregularities or impropriety during the year, then they should be reported within this statement with monetary amounts if known. What we often see within academy accounts is that the governance statement may allude to some of this in a little bit more detail, with cross-referencing in the regularity statement by the accounting officer and maybe in the regularity audit report back to the governance statement where the detail is included. What the ESFA have done this year, again, relates to the estate safety and management. There is a specific addition to the accounting officer's statement this year around estate safety and management, so acknowledging their responsibility in that area. So they are the main narrative statements I just wanted to cover. As I said, the other statements are either driven by your auditors or are very, very prescriptive in nature. So if we'll spend the rest of the time of this section really looking at the presentation of the financial results and some of the disclosures within an Academy Trust set of accounts. So the first, if we just scroll down a couple of slides. So the first area to look at is your statement of financial activities. So covering the income and the expenditure for the financial year. As I said, the presentation of this very much follows the requirements of the charity statement of recommended practice, and therefore you have fund accounting within here. And typically within a trust set of accounts, you'll have 3 fund columns, and then coming to the total with the total for the prior year as well. So really your operational funds within this statement will be your unrestricted funds column, and then your restricted general funds, and then you have capital funds, which are your restricted fixed asset funds. It is just worth noting within this presentation, the restricted general fund includes your pension reserve. So as you will see here at the bottom of the total at the bottom, that column is negative. That's often the case and has been the case because your pension reserve represents your share of the deficit of the local government pension scheme. So will be a liability normally, or has been in the past, and therefore it brings that fund into negative. So when we get to the balance sheet, you'll see that the negative there at the bottom of the page is actually comprised of a positive restricted general fund balance less a negative pension reserve. Sorry, if we just go back up to the statement of financial activities. So really the majority of your educational funding will be coming through your restricted general fund, any restricted donations, so donations for specific purposes. Capital grants will come through on that donations and capital grants line, but in your restricted fixed asset fund. And then your core educational funding, so your general annual grants, other DFE, ESFA, local authority grants will come through in your educational operations line within the restricted general fund. And you can see that in the example within the model accounts. So the bulk of income is within the restricted general fund. In terms of your restricted fixed asset fund, so that will be capital grant receipts that are coming through. So the 554,000 there you can see in income. And then typically the spend against that fund will be your depreciation charge. So when you're looking at the model accounts, you can see, so the 949,000 that's charged in this restricted fixed asset fund is 3,000 that is amortization on intangible fixed assets, and 946,000 is your depreciation to tangible fixed assets. When you look at that offline, then you'll see that where that 949 comes from. What you may also then have, and there's a very small amount represented here, which is a transfer out of restricted general funds and into restricted fixed asset funds. So this is 3/4 of the way down the page, the -10 going into a +10 into the restricted fixed asset fund. So that is representing any revenue, operational funding, or Could be from unrestricted funds, could be from restricted general funds, any revenue funding you're spending on capital, so on fixed assets. So this trust is saying they spent £10,000, for example, from the general annual grant on fixed assets during the year. The aim, therefore, is that all of your capital assets are held within the restricted fixed asset fund. And you can ultimately then reconcile your total fixed asset fund, so the 10.125 million here, you can reconcile that back to the carrying value of fixed assets in the balance sheet. So you will often see that transfer. Often for trusts, that 10,000 will be a much bigger value. Just a reminder on new schools coming in, you can see this in the model accounts, but in the comparative. So we've got 8976 within income for the prior year. That's the value of the net assets that were transferred in for a new school in the prior year. So this will comprise budget surpluses from those schools that are transferred in, property, so land and buildings valuation, and then a local government pension scheme, probably a liability. If it is a liability, that's shown as negative income. So basically these accounts are saying that in the prior year, to the tune of almost 9 million, the trust benefited to that degree from net assets from a school or schools coming into the trust. And that's whether they're local authority schools previously or coming from another academy trust. And then there'll be further analysis of that within the notes to the accounts. What's often worth doing is just reconciling this page of the statutory accounts to your management accounts. And as I said, it's the management accounts will be really the basis on which you're budgeting and is your sort of true underlying operational result. That operational result will be seen by looking at your unrestricted funds plus the movement on restricted general funds, but stripping out the pension reserve movements. And that is the figure that you should be able to reconcile to your management accounts figures at year end. So if we just then move to the balance sheet, just to flag a few points on here. So as I mentioned, if you look at the bottom half of the balance sheet here, on the statement of financial activities, we had the negative restricted general fund. When you look at this at the bottom of the balance sheet, you can see actually that restricted general fund was made up of a restricted income fund of 464 less the pension reserve of 1.4 million. The pension reserve balance is exactly equal to the pension liability further up the page. What we also have within here is intangible fixed assets and tangible fixed assets at the very top of the page. So they total 9969. Your fixed asset fund value is 10.125 million. So that's greater than the carrying value of fixed assets. And that's because you have the trust has 156,000, the difference between the two, of unspent capital funding. So your restricted fixed asset funding equates to the carrying value of fixed assets plus any unspent capital funding. If you're then looking at this to work out actually what does the trust have as working capital, the key figure to look at is halfway down the page is the net current assets, which equates to 898. And just looking at this, that comprises the restricted income fund of 464, the unrestricted fund of 278. You can see both of those figures at the bottom of the page, plus your unspent capital funds of 156. All of those three combined come to that 898. And that really, from understanding where you are as a trust at year end, in terms of the movement of that figure year on year, that's a critical figure really. In addition to that, you have your long-term pension liability and the fixed assets, which are not liquid. So really, that's a critical figure operationally to understand. Just to say on the pension liability, so in the model accounts, you've got negative a liability of 1.4 million. What we're expecting to see this year, and we saw it slightly for some trusts last year, is that because of the movements in interest rates, we're expecting to see far more surpluses on local government pension schemes. So what actually that means is that there's an asset rather than a liability. However, under accounting standards, you don't recognise that asset. You would cap it at 0 unless the surplus is recoverable within the scheme. Probably unlikely, but the assessment of that would be coming through within your actuary's report. So what we're expecting to see this year is surpluses in schemes for your share of the schemes, but that on the balance sheet that would be capped at 0. But it will have to wait to see some of those actuaries' valuations come through, but that certainly seems to be the expectation at the current time. If we then just look at the remainder of the accounts in terms of other requirements, presentation here, so just moving down to the next slide. We have the accounting policies, so for all material items within the accounts, you should have a policy. Coketown gives you all of the sort of industry standard policies that you can follow and that the majority of trusts follow. Just to note here, I mentioned going concern earlier, that will come through in the trustees report. You also need a statement on going concern as replicated in terms of the requirements here in the accounts direction. So really making sure that, yeah, and particularly if solvency is in question, you'll need to expand the statement quite significantly, and as a minimum that 12-month period is applicable. Also recognition within the accounting policies and of any material areas of judgment, critical estimation as well within there should be reflected, but Coketown does include examples for some of those. Moving down just to the notes to the accounts. So firstly, the income notes. So there is a note within the accounts direction within the model accounts that is not applicable to most trusts. Some of the very original trusts, academies that were set up, had within their funding agreement a restriction on how much GAG funding could be carried forward year on year. If that is relevant, you need that disclosure within the accounts. Most trusts, you won't need that. The main income note is the note that's replicated here, which is the funding for educational operations. If you have boarding activities, you would also be including any information. Teaching school hub here comes through as well. Just to note this year, and an emphasis within the accounts direction, a lot of trusts previously were lumping together any other DFE and ESFA grants. What they've required this year is that you separate out any significant material grants within that disclosure. So just make sure you're listing those individually within this note. Moving down just on the expenditure notes. Pretty stable year on year here. Again, if you have the teaching school hub, then you should be separating out the costs as well, and also boarding activity costs as well if relevant. One point of clarification this year within the accounts direction is that the cost of teaching assistants should be categorised as support staff costs rather than educational staff costs. What we also have within the expenditure notes, not replicated here, but in detail in the accounts direction, is disclosure of any losses, write-offs, compensation payments, gifts, bad debt losses, write-offs. So you show those in aggregate, and then if there are any individual amounts over £5,000, you have to disclose those with the reason for those payments as well disclosed. A lengthy note for within expenditure. So just scrolling down to the next slide is the staff costs note. So there are actually no changes here this year, but there continue to be really lengthy disclosure requirements, and it is worth just familiarising yourself with this before preparing the accounts in order to gather the right level of detail, particularly for multi-academy trusts, if you need to go to schools within the trust to get the relevant disclosures. So requirements for separation of agency costs, agency staff costs, restructuring costs, the requirements that came in last year around severance payments and the bandings and numbers for those, any special payments, higher paid staff, so the bandings remain 10,000 £10,000 bandings for those earning over 60,000, so no increase in the sort of starting threshold there. I mentioned key management personnel, so the aggregate pay to that group of individuals, so probably the SMT, and then also any trustees' remuneration. So if you're a trust that still has staff members, chief exec, for example, who is a trustee, then disclosure there as well of their remuneration, with separate disclosure of pension contributions in bandings as well required. So yes, do look at that note really carefully. Scrolling down again to the next slide, related parties, again, no specific changes in reporting for this year, but obviously an area that the ESFA are very much keen on. We know that they scrutinise the related party transaction note to the accounts, and will then come back to trusts with specific questions around that, and they try to match sort of disclosures in the accounts with the approvals that have taken place online. So really being as clear as you can here, confirming that you have met the Academy Trust handbook requirements as well for any related party transactions that have taken place within the year. So the ACCOS requirements, the approvals, etc. But the disclosure in the model accounts is really useful and can be given as a really good guide to what you need to do. So just finally from me, just in terms of other notes to the accounts, just on the final slide of this section. So as many trusts are now, they are multi-academy trusts, so include a number of schools, academies within the trust together with the central office. So number of disclosures required, and there's a section within the accounts direction guidance around disclosures specifically required for multi-academy trusts. So what are those? Expenditure by school required to be given. Also revenue reserves by school, obviously unless you pool your reserves where there is no requirement. Where you do not pool reserves and you have your list of revenue reserves by school, what you may have is deficits against some of those, cumulative deficit balances against some of those schools. If you do, you must explain those and also the action that you're taking to bring those schools out of a deficit position. You'll also have a note to describe your central services, so how that works in terms of cost recharges or top slicing arrangements, and the amounts charged by school as well. So a clear idea of how the MAT is structured, both financially, central office and the schools, and how that sharing of costs, top slicing works across the trust. Also, for any academy trust, various reserves disclosures. So often a note that needs quite a bit of work early on in the accounts preparation process, because what you'll have here is the allocated expenditure against each fund as presented on the statement of financial activities, but you will be going into more detail here. So it's looking at the expenditure against each material funding stream as well. So how much of your GAG have you spent, how much of your pupil premium, etc. So being able to allocate your costs against each funding stream, and obviously that reserves disclosure then needs to tally with what you're showing earlier within the accounts in terms of carry forward balances, income, expenditure, etc. So it is a pretty key note in making sure that is correct. Commitments, so operating lease commitments, very common across trusts, probably not significantly material, but nevertheless the total commitments under those operating leases need to be given as replicated here. You may have other longer term commitments, much more material commitments, PFI schemes for example, where there's a significant cost. So the trust's future minimum payments under those schemes very much required to be given and disclosed within the notes to the accounts. The only other change I wanted to mention is the only other change that's come in this year, which is the treatment of concessionary loans. And again, it's more a clarification than anything. So within the creditors' guidance, within the overall accounts direction, it notes that if there's a loan in place and it's concessionary, so that the interest charge is below market rates, then that element of benefit the trust is receiving should be reflected in the accounts. And this is one area where they don't go into much more detail. They refer to the charity statement of recommended practice guidance here. But just be aware, I think it's probably relatively likely to be relatively rare in terms of trusts having this in place. Many trusts don't have loans given the requirements of the trust handbook as well. But if you do have any concessionary loans, have a look at this specific guidance under the liabilities and creditors section of the accounts direction. So that really concludes the first section, looking at the accounts and reporting framework. I'll now hand to Matt, who'll look at some of the changes of the auditing standards.
Great. So just within this final section, just want to talk about those changes to auditing standards and how those are going to impact audits for this year. So just coming on to the slide really, so the auditing standards are updated regularly, and this is really in response to changes in the risk profile of organisations as a whole, and also in response to any periodic reviews into the audit sector, which might highlight any gaps in regulations as they currently exist. So the updates that we're seeing this year are really in response to reviews published in 2018 and 2019, and the two key standard updates to flag here are ISO 315, which is in respect to identifying the risk of material misstatement, and ISO 240, which is the auditor's responsibilities in respect to identifying risk of misstatement through fraud. So the first standard to note here is ISO 315. So there's a range of updates to requirements for audit responsibilities in respect of this risk assessment. And a lot of those changes won't necessarily impact the day-to-day interaction you'd have with your auditors. There are, however, some requirements within the update here which are likely to impact that audit interaction and might require some element of preparation on your end as well. So there's some reinforced requirements here in terms of the way auditors are required to sort of document the policies, procedures and controls around key business processes and the related testing that they're required to perform. So in particular, there's an additional emphasis here on requirements around assessment of the IT environment, the systems used and the data flows between different applications within the IT environment. So a lot more focus on IT within this update to the auditing standards. There's also requirements in place to ensure that, that there's processes in place to capture items which may impact the financial statements but aren't necessarily purely financial in nature. So this includes, for example, how those preparing the financial statements would be made aware of any potential litigation that might be ongoing that might give rise to a sort of actual or contingent liability. So if, for example, there'd been a breach of health and safety legislation at a school within an academy trust, how that would make its way through to those preparing the financial statements to ensure that they are aware of any potential uninsured liabilities that might require reflection in there. And in terms of ISO 240, which is around fraud, so the changes to ISO 240 mean that there's specific requirements to assess your procedures and make inquiries to those key personnel who are delegated responsibility for reporting of fraud. So in addition to those inquiries with those personnel, you may also see additional testing in areas where there's a heightened risk of fraud. And really to give an idea of some of those potential areas, there's a really good ESFA fact sheet that's been updated last month on fraud, and that gives an indication of some of those areas that might be seen as key areas of fraud for your trust. So just coming on to the next slide as well, just wanted to give some indication of the sort of overall impact from an audit perspective. So there's going to be additional requests from auditors. We are, for example, issuing all clients with an IT questionnaire, which we'll come on to in a bit more detail when we pass through shortly. There's also consideration of the audit timetable. In particular, there may be a bit more emphasis on interim work to allow, where necessary, for those systems and controls, in particular those IT systems, to be reviewed and assessed in advance of the field work being performed. And there may also be further discussion with individuals outside of the finance team. So from a fraud perspective, that might be to do with anyone who's responsible for having fraud reported to them. But there may also be discussion with your IT team, for example, to understand some of those IT procedures in a bit more detail. So there may be a bit more organisation required, a bit more collaboration across the broader sort of team as part of that. In terms of that impact then at planning stage, which begins on this slide. So as part of ISA 315 assessment, we're providing all clients with an IT environment questionnaire. So the purpose of this questionnaire is really to provide that key information on which we're going to base our risk assessment. So we're trying to really understand through this questionnaire sort of the complexity and maturity of your IT systems, as well as areas of potential presence of risk. And that's really just going to impact the work performed as part of the audit field work and the balance of sort of sample-based versus control-based testing. At this stage, we're also going to assess any sort of related audit work performed by other parties, for example, internal assurance, which might impact our risk assessment. So we're looking at the work of internal auditors, for example, as well as any other assurance you may have in place over the control environment. So for example, if during the year you'd received Cyber Essentials or Cyber Essentials Plus certification, that's going to provide us as auditors with information as to the minimum criteria that you're meeting within your IT systems there. When we're looking at that IT environment in general, there's really three areas we're considering. On the following slides, we'll see those in a bit more detail. So those areas are the IT operations, firstly, secondly, the access management side of things, and thirdly, the change management side of things. So just moving to the next slide, we've given an example of each of these areas just to give a bit more of an idea of what we're actually looking at here. So in terms of IT operations, the focus of this kind of area is really looking at those overriding network controls, processes around sort of data backups, the level of integration of systems, as well as the maturity of systems. So an example we provided here on this slide is those data backup processes. So if there weren't processes in place here, there's a risk that financial data might be lost or might be irrecoverable in the event of a systems failure. So we're really looking for a control to be in place to ensure that regular backups have been established and that there's a schedule and frequency that's being monitored there to ensure that they're being backed up at an appropriate interval. And this is something that can be tested as well, something that can be looked at. So looking to see whether there's reference to backup logs and backup files to ensure really there that we've got that there's that audit trail, that the process is being implemented as it's designed. On the next slide here, we're taking a bit of a look at access management. So this is all around the risk that users are able to access and perform functions on the IT system, which they shouldn't be able to. So in this instance, an example of a control which we'd expect to be in place is that when an employee leaves the organization, that their IT privileges are removed in good time. So again, this is something that we should be able to test here. We should be able to reference active users against employee lists within the organization, or check specific departed staff members to ensure that they've had their access removed. And by ensuring that this kind of control is in place, it helps ensure and reduce the risk of fraud of any individual within the organization perpetrating fraud. Then the final of these three areas, which is just on the following slide, is with respect to change management. So the example of a risk here is that the changes can be made to a database, to a structure of database or relationships between data without privileges being required. So some databases you might have, for example, could be approved supplier listings, it could be a contracts register, and there's controls that you'd expect to have in place around that. So you'd expect there to be approved procedures for changes being made to those kind of details and evidence of authorization of any kind of those changes. And again, this is an area you might see a bit more questioning about, a bit more testing around your audit. So checks to determine whether it's possible to amend those databases manually, and also the extent to which any segregation is enforced, as well as any evidence of approval of sort of changes in supplier details there. So just thinking really, how does this feed through to the audit work as a whole? So this is covered on the next slide, and it's really that assessment at that planning stage, which is going to impact the overall audit approach. So if the entire IT environment's more complex and there's use of automated procedures, additional checks of control are going to be needed as part of the audit work. There'll be more emphasis really on checking reconciliations and verifications at the field work stage. So really that first stage is the risk assessment, and then the second stage, the audit field work, is going to depend on what comes out of that initial risk assessment. So you might just see a bit of a change in emphasis of your audit. You might see some tests that are slightly more unpredictable, some slightly newer tests on that side. The final area then, just coming onto the next slide, is around ISO 240. So this is the revised fraud ISO. So just providing a bit more detail on the impact of this side of things here. So audits in the education sector and the academy sector have always had slightly more emphasis on this area already due to the requirements around regularity reporting. So as part of this, as auditors, we've always had a bit more focus on those areas where there's that higher risk of fraud being perpetrated. So you'll have always had your auditors look at things like credit card transactions, looking in depth at those authorization processes. And while this will be looked at in past and won't necessarily be impacted, you might also see some additional questions, some additional queries and checks around processes and areas where fraud could be committed externally. So things like how suppliers are set up on your banking systems and the processes that are in place around those kind of areas. And also more broadly looking at things like the training that's provided to staff around fraud and how to look out for fraud. There's also that requirement which was previously mentioned around making inquiries to individuals within your organisation with that responsibility for monitoring reports of suspected fraudulent activity. So you may just recognise that there's those questions being asked in that area as well. But in terms of any actions that will be needed from trust in this side, it's really a case of ensuring that your policies around fraud and fraud prevention and training of staff there are really up to date, that any fraud related matters are communicated to auditors during the year as well, because there may be requirements within this revision to the standard to involve forensic accountants in cases where a complex fraud is potentially occurred during the year. And there may also be requirement here to consider the potential risk of fraud at school level as well, and processes and checks around ensuring that that fraud at school level isn't taking place. So common area that's quite high on the ESFA radar at the moment is around conflicts of interest at a local level. So how those sort of conflicts of interest at a local level are documented, and the knowledge of potential connected parties at a sort of smaller level than the trust as a whole. So the final slide, just turning over here, is really what are the benefits of these revisions to the standards. So really it's going to help ensure that that audit approach remains robust. So including that consideration of fraud areas and that enhanced scrutiny over the IT environment. For you as an organisation, it's going to help you understand your own information flows and risk assessment process better. The revisions to the standard also highlight the broader use of IT across all organisations. So it provides a chance here just to reflect as to whether existing risk mitigations are as strong in those areas as they should be, and look at things like staff training or internal audit input to ensure that those risks are reduced to an appropriate level. As part of audits, we're generally finding as well that we're identifying areas of potential inefficiency or control weakness. And we're finding that following these changes to the auditing standards, there's tending to be additional control observations within part of our post-audit reporting around these kind of areas. So it's really a good opportunity to improve the control environment which arises from this. But that really sort of concludes the updates as to those updates on the auditing standards. I'm just going to pass back now to Kath for any questions and to wrap up on the session as well.
Great, thank you very much, Matt. We actually have no questions whatsoever. So if there are questions following the session, if you're rewatching the session, if there is anything, then always welcome to follow up with us, your normal Buzzacott contacts, if you have any questions at all. So really we'll wrap up there. Many thanks for attending. As I said, we'll circulate the slides and the recording afterwards to all of you who've attended and those others who've signed up as well. We do have part 2, which is more focused on the practical side of accounts preparation for this year end and audit as well. That will be at the same time, so 2:30 next Wednesday, so Wednesday the 19th of July. So many thanks once again for attending. Thank you.